everyone. Let's work through problem 22-3A and let's cover requirements 1 and 2 dealing with break-even, income targeting, and forecasting. Okay, the problem appears before you. Jetson Company sold 20,000 units of its only product and incurred a 50,000 loss. Now we're ignoring taxes in the current year, which is 2005. Now during a planning session for next year, the production manager notes that variable cost could be reduced 50% by installing a machine that automates some operations. But to get those savings, the company must increase its fixed cost by 150,000. And we're assuming they're going to buy a piece of equipment here, which will increase its maximum output capacity of the company to 40,000 per year. Now, the contribution margin for 2005 appears in the table before you. So let's compute break-even in dollar for 2005. Okay, first let's compute, let's write down what the break-even formula is. So break-even in sales dollars is going to be equal fixed costs, right? This is right out of our text, over the contribution, if I can spell it, margin ratio. Okay, now let's compute the contribution margin ratio on a per unit basis, because that has some value to us as we look to solve part 2. Okay, so what's our sales price per unit? Well, our sales price per unit is equal to 750,000, the first number appearing in the table, right? Divided by 20,000 units. We get that from right there to the left of my mouse, from our data from 2005. Okay. Oh, I made an error here. It needed something. I didn't catch the error. It moved pretty quickly there. Okay, let's put that in dollars. So our sales price per unit is $37.50. Let me indent this a little bit so we get a little bit of an offset. Now, what's our variable costs per unit? Okay, well, our variable cost per unit would be equal to the 600,000 total variable costs divided by 20,000 units, $30, and let's use the same formatting just for the sake of consistency. So if we compute our contribution margin ratio, let's do that. And the way we can compute that is we can take the $37.50 minus the variable cost to come up with contribution margin, and then divide it by the $37.50. Okay, so we'll divide it by cell D23, and I know you can't see it's D23, but you'll just have to work with me here, and it's an even 20%. Okay. Now we could have computed a 750 as the contribution margin per unit and then divided 750 by 50, but I did that in one cell just because we don't have all that much real estate. Okay, so now that we've done that, let's compute break-even. Well, break-even would be equal to the fixed costs, right? We have the formula up here. Let me bold that. And I think what I'll do is move this down here, slide this up. This calculation here was our contribution margin ratio. And we'll calculate break-even, so we'll put in the fixed costs which were equal to 300,000. Is that correct? 200,000. Okay. Widen my column. I will decrease that. And our contribution margin is the 20%. I'll just put that right here. I'll label it here. We've calculated that from above. And all we have to do is divide it to come up with break-even. So we will take that cell, 200,000, divided by 20%, and that tells us, and we're going to turn that to dollars now, that tells us that break-even in sales dollars would have had to have been $1 million for the company to break even before taxes, and that takes care of part 1. Okay, now let's look at what part 2 wants. Compute the predicted break-even in dollar sales for 2006. Assume we go ahead with the machine installation and there's no change in unit sales price. Okay, well, let's look at what our new fixed cost would be for 2006. Now what I'm going to do is move all of this down. I'll do a cut and paste and see if that worked right. Yep, so you can still see that. And we'll label this 2005. And let's see if we can solve it for 2006. Let me widen this a little bit. Okay. Sorry for the little bit of jumping you see. Now, what we have to do is first compute our new change in the contribution margin. Now the sales won't change, so that remains the same. But the variable cost dropped by 50%. So instead of $30, we need to take that times 50% or divide by 2, either way. And therefore, we can copy this formula over and come up with a new contribution margin of 60%. Now, fixed costs, though, we're going to increase by 150,000. So we need to take the 200,000 plus 150,000. You see where I'm doing that, right? I'm grabbing it from the cell to the left. The new contribution margin is from the 60% below. And therefore, the break-even under the new circumstance is $583,333. And those are the answers we were looking for in parts 1 and parts 2. I'll bold it so that you can see it. And that's all I want to cover at this point.